What if I told you that everything you think you know about building wealth is backwards? Most people believe wealth grows in a straight line. Put in money, get a little return, repeat until retirement. But here's the thing that will blow your mind. The math of compounding follows a specific rhythm that's so predictable, it has a name. The 8-4-3 rule. And once you understand this pattern, you'll never look at your investment timeline the same way again. Here's how it works. It takes 8 grueling years to hit your first major milestone, then just 4 years to double that achievement, and finally, only 3 years to replicate that entire journey again. Same monthly contributions, same market conditions, but completely different results. If you don't understand this timeline, you're practically guaranteed to quit right before the magic happens. You'll walk away in year 7 thinking the system is rigged, when you're actually 1 year away from the acceleration phase. Today I'm breaking down the 3 psychological phases that will either make or destroy your financial future. We'll look at real numbers so you can see exactly how this works, and I'll show you the traps that kill this process before it can work its magic. Because here's the catch. This rule is bulletproof, but only if you don't sabotage yourself along the way. Before we dive in, if you want to understand how money really works without the get-rich-quick nonsense, hit that subscribe button. It's the best investment you'll make today, and it helps me create more content like this. Let's start with phase 1. I call these the suffocating years. This covers years 1 through 8, and it's where 90% of would-be investors throw in the towel. Mathematically, here's what's happening. You're contributing consistently every month. Maybe it's $500, maybe it's $1,000. The market is doing its usual dance. Some years up 10%, some years down 5%. But because you're starting from zero, the actual dollar gains from market returns are tiny compared to what you're putting in from your paycheck. During these first 8 years, you're carrying the entire load. The market is helping, sure, but it's like having a friend who promises to help you move and then only carries a single lamp while you haul all the furniture. You look at your account balance in year 5 and think, I've been sacrificing for half a decade and this pile of money is barely bigger than what I contributed. Is this even worth it? This is where the psychology becomes dangerous. Because the growth feels painfully slow, your brain starts manufacturing excuses to quit. You begin thinking about how that money could buy a new car, fund a home renovation, or pay for that dream vacation you've been postponing. You convince yourself that investing is a scam designed for people who already have money, or that you somehow picked the worst possible funds. But nothing is actually wrong. This sluggish pace is a feature, not a bug. In phase 1, you're not really investing for returns yet. You're investing for critical mass. You're building the foundation that will support everything that comes after. Think of it like packing snow into a tight ball before you can start rolling it downhill. If you abandon ship in year 7 because you're bored or discouraged, you never reach the tipping point. You've paid the price of discipline but walked out before claiming your reward. The 8-4-3 rule tells us this grind lasts approximately 8 years. It's a marathon, not a sprint. It tests your character more than your mathematical skills. But if you stick it out, the physics of your money begins to shift dramatically. Then comes phase 2, years 9 through 12. These 4 years represent the middle section of the 8-4-3 pattern. Suddenly, everything starts feeling different. You're still making your monthly contributions, but now the market is matching your effort. In strong years, your portfolio might grow by more than your entire annual salary. This is the moment you transition from pushing a car uphill to jumping in and letting momentum take over. In just these 4 years, your money typically grows as much as it did during the entire previous 8 years combined. Think about that efficiency. It took you 96 months of grinding to accumulate your first block of wealth. Now you're generating that same block in just 48 months. You've literally doubled your pace. This is usually when people start getting genuinely excited about personal finance. They stop dreading the monthly transfer and start anticipating it. The returns on your previous returns are now generating their own returns. It's compound interest becoming compound growth, and it's incredibly powerful. Your original contributions from year one are now a decade old and have been quietly multiplying in the background. Psychologically, this phase feels like vindication. You realize that all those experts saying time in the market beats timing. The market weren't just repeating empty slogans. You survived the volatility of the first 8 years, you weathered a market correction or two, and now you have the emotional calluses to prove it. You're less likely to panic sell because you can see the momentum building. The machine is finally working. You're no longer hauling that couch by yourself. The market has shown up with a moving truck. But here's what will absolutely blow your mind. As satisfying as Phase 2 feels, it's just the warm-up act for the grand finale. If you thought doubling your speed in Phase 2 was impressive, Phase 3 will make your brain malfunction. We're evolved to understand linear growth, like walking from point A to point B. We're terrible at grasping exponential growth. Phase 3 covers years 13, 14, and 15, just 36 months. But in this brief window, the mathematics go completely vertical. This is the section of the growth chart that looks like a hockey stick. And critically, if you miss the first 12 years, you can't just jump in here and expect the same results. You have to earn your way to year 13. In these final 3 years, your portfolio generates another massive block of growth equal to what you achieved in the previous 4 years, which remember was equal to the first 8. So in just 3 years, you're accumulating wealth at nearly triple your starting pace. At this point, your monthly contribution almost becomes irrelevant. Keep doing it because discipline matters, but the heavy lifting is now completely automated. The interest is earning interest on the interest, which is earning interest. You might have days where the market moves up 1 or 2%, and that single day's gain exceeds what you earn in a month at your job. It feels surreal. It seems like you suddenly got rich, but you didn't. You just waited 15 years for the compounding curve to go vertical. This reveals why quitting early is so catastrophic. If you cash out at year 10 because you want to buy a boat or pay off your house early, you're not just spending your principal, you're assassinating the exponential phase. You're chopping down the tree right before it bears fruit. The 843 rule shows us that the majority of your reward is backloaded and hidden at the very end of the timeline. It's like running a marathon where they give you the medal at mile 26, but if you stop at mile 20, you get nothing but sore legs. This explains why the wealthy keep getting wealthier. They have the capital and patience to stay in the game until year 15, year 20, year 30. They live permanently in Phase 3 while everyone else is still struggling through Phases 1 and 2. Let's ground this with actual numbers so you can see I'm not spinning fairy tales. Say you invest $500 monthly into a diversified equity fund. We'll assume a long-term average return of 10%. Obviously, the market doesn't deliver smooth 10% returns every year. Some years it's up 30, some years it's down 20, but historically, 10% is a reasonable baseline for equity returns over 15 years. You're contributing $6,000 annually. After 8 years of Phase 1, you've contributed $48,000 of your own money. With growth, your balance sits around $70,000 to $75,000. Not bad, but you're not retiring on it. It took nearly a decade to reach that $75,000 mark. Now watch what happens. You continue your 500 monthly contributions. 4 years later, at the end of Phase 2, you hit year 12. Your balance is now roughly $130,000 to $140,000. You added almost as much value in 4 years as you did in the first 8. Then comes Phase 3, years 13, 14, and 15. By the end of year 15, you're pushing past $200,000. In those final 3 years, the growth surged again. You went from $130,000 to $200,000 in what feels like a blink. The gaps between the years get wider and wider. Flat, then steep, then vertical. That's the pattern. You didn't work harder in year 15. Your money did all the work. So how does understanding this change your behavior? First, it destroys the desire for quick wins. When you grasp the 8-4-3 timeline, you realize that trying to double your money in 6 months isn't investing. It's gambling. Real wealth building is a 15-year minimum commitment. It forces you to zoom out. Instead of asking what stock is hot right now, you start asking what process you can sustain for 15 years. It makes you respect the boring, repeatable systems. Automated transfers, index funds, dividend reinvestment. You stop hunting for lottery tickets and start looking for a shovel, because you know the gold is buried deep, not lying on the surface. Second, it makes starting immediately non-negotiable. If the magic happens in year 15, every year you delay pushes that payday further into the future. If you start at 20, you hit your first exponential phase at 35. You have time for a second or even third cycle in your lifetime. If you wait until 40 to start investing seriously, you don't reach that first vertical climb until 55. You're running out of runway. The cost of delay isn't just the money you didn't contribute, it's the time you stole from your future compounding curve. You can always earn more money to invest later, but you cannot manufacture more time. Time is the one asset you cannot dollar cost average. Here's another mental shift that might surprise you. Volatility becomes your ally. When you're in the first 8 years, a market crash is actually the best thing that can happen to you. I know that sounds insane, but think about it logically. You're in the accumulation phase. You're a net buyer of stocks. If the market drops 20% in year 4, you're buying shares at a discount. You're loading the spring. When the market eventually recovers, which it historically always has, you have more shares compounding for you in the later phases. If you understand the 15-year timeline, a crash in year 4 is just a clearance sale at your favorite store. You don't panic. You go shopping. However, there's a silent killer in this equation that can ruin everything. Fees. To make the 8-4-3 rule work effectively, you need clean compounding. If you're paying a 2% management fee to some fund manager who consistently underperforms the market, you're dragging an anchor behind your speedboat. 2% sounds trivial, but over 15 years, it devours a massive portion of your exponential growth. It flattens the curve. This naturally pushes you toward low-cost index funds or ETFs. You want to capture broad market returns, not pay for someone else's yacht. Keep your costs minimal, keep your allocation diversified, and let the mathematics work without friction. So how do you actually implement this? Step 1. Define your 15-year goal. What is this money for? Retirement? Financial freedom? A house? Give it a specific name so you'll stick to the plan when temptation strikes. Step 2. Automate your contributions. The 8-4-3 rule depends on consistency, not willpower. Willpower fails when you see a shiny new gadget or when market headlines get scary. Automation doesn't care about your emotions. It just executes. Treat that monthly investment like a utility bill, a tax you pay to your future self. Step 3. Choose the right investment vehicle. For most people, that's a global equity index fund. Simple, boring, effective. Don't overcomplicate it with 30 different niches, sectors, or exotic investments. Step 4 is the hardest part, the commitment. You must promise yourself you won't interrupt the machine. You won't raid the fund for a wedding. You won't stop contributing because the news says a recession is approaching. You have to protect the timeline. You're not just managing money, you're managing your own behavior. If you can stay boring for 15 years, you win. It's the ultimate get-rich-slow scheme. And unlike the quick schemes, this one actually works in the real world. The 8-4-3 rule isn't a guarantee of specific returns. The market is chaotic and unpredictable in the short term, but as a framework for visualizing wealth building, it's unbeatable. It teaches you that the hard work is front-loaded and the rewards are back-loaded. It explains why the first decade feels like a grind and why wealthy people seem to make money effortlessly. They're not smarter or luckier. They just survived the first 8 years so they could enjoy the last 3. Your job is simple. Plant the tree, water it consistently, and resist the urge to dig it up every year to check the roots. The magic happens underground. where you can't see it, building the foundation for what's coming. If this perspective changed how you view your own investment timeline, let me know in the comments. Are you currently in the grinding 8 years, the accelerating 4, or the exponential 3? I'm curious to see where everyone stands. And if you know someone who's about to quit investing because they're not seeing fast enough results, share this video with them. It might prevent them from making a very expensive mistake. Thanks for watching, and I'll see you in the next one.